Have you ever wondered why you make certain decisions with your money, even when you know they're not the best? The world of finance can be complex, but what if the biggest obstacle to making smart financial decisions isn't the market itself or your financials, but your own mind? What if I told you that your brain might be tricking you into making these choices? Stay tuned, because today, we're diving into the fascinating world of behavioral finance and uncovering the hidden biases that influence your financial decisions. Today, we're exploring cognitive biases in behavioral finance, a field that combines psychology and economics to explain why we make the financial decisions we do. Understanding these concepts can help you make better choices with your money and achieve financial freedom. Ready to take control of your money choices? Let's get started. Let's begin with anchoring bias. Anchoring bias happens when we rely too heavily on the first piece of information we get, the anchor, when making decisions. Imagine you see a jacket that costs $200. Later, you find another jacket for $100. Because you saw the $200 jacket first, you think the $100 jacket is a great deal, even if it's still more than you'd typically spend. Research by Amos Tversky and Daniel Kahneman, pioneers of behavioral economics, showed that initial numbers can significantly influence our decisions. Sales and discounts often use anchoring. A store might show you the original price of $50 to $25 to make you think you're getting a bargain. To overcome anchoring, regularly update your knowledge with current data and market conditions rather than clinging to outdated information. Next, we have loss aversion. Loss aversion is the idea that people feel the pain of losing money more strongly than the pleasure of gaining the same amount. You're more likely to avoid losing $50 than you are to try to gain $50. This can make you overly cautious. Studies have shown that losses are psychologically twice as powerful as gains. This was detailed in Kahneman and Tversky's prospect theory. An example is when investors hold on to losing stocks too long, hoping to avoid realizing a loss, rather than selling and moving on to better opportunities. To counteract this, set clear goals and limits to help you make rational decisions and avoid holding on to losing investments due to emotional attachment. Now, let's discuss overconfidence bias. Overconfidence bias is when people overestimate their knowledge or abilities. People might believe they can predict the stock market better than they actually can, leading to risky investments. Research shows that overconfidence can lead to poor decision-making and excessive risk-taking. After a few successful trades, you might believe you're an expert, causing you to take on more risk than you should. To counter this, seek diverse opinions and perform thorough research, ensuring you're not overestimating your abilities. Ever bought a stock just because everyone else is? That's herd mentality. Herd mentality is the tendency to follow what others are doing, rather than making independent decisions. If everyone is buying a particular stock, you might feel the urge to do the same, fearing you'll miss out. This behavior is linked to the social proof principle, where people assume the actions of others reflect correct behavior. A classic example of this is during the dot-com bubble of the late 1990s, where many investors jumped into tech stocks simply because everyone else was, leading to a massive market crash. Instead of jumping in the bandwagon, base your investment decisions on your own analysis and long-term strategy, rather than simply following the crowd. Confirmation bias is next, where one have the tendency to search for, interpret, and remember information in a way that confirms one's preconceptions and ignore anything that contradicts them. You might believe that a certain stock is going to rise and only seek out information that supports this belief while ignoring evidence to the contrary. This bias can lead to poor investment choices and ignoring crucial information. A real-life example is when investors stick to their initial investment strategy even when new data suggests they should change course. To overcome this, challenge your assumptions by actively seeking out information that contradicts your beliefs. Then, there's mental accounting, which is when people treat money differently depending on its source or intended use, which can lead to irrational financial decisions. You might treat a tax refund as extra money to spend on a treat, rather than as part of your overall budget. Richard Thaler, a key figure in behavioral economics, introduced this concept, highlighting how it can lead to irrational financial behavior. We can see this at play when people save for a vacation while carrying credit card debt, even though paying off the debt would be financially wiser. To counter this bias, treat all money with the same level of importance, regardless of its source or intended use. Gambler's fallacy is another cognitive bias. This is the belief that future probabilities are influenced by past random events in a way they are not. If a coin lands heads up several times in a row, you might believe tails is due next, even though each flip is independent. This fallacy often leads to poor financial decisions, like continuing to gamble after losses expecting a win is due. This bias is in effect when betting on a stock to rebound just because it has been falling, without any fundamental reason. Overcome this by understanding that markets are unpredictable and focusing on long-term strategies. Status quo bias is the preference to keep things the same rather than change, even if change could be beneficial. People prefer to stick with their current investments or financial plans, even if better options are available. This bias can lead to missed opportunities and stagnation in financial growth. Keeping money in a low-interest savings account rather than exploring higher-yielding investments is an example of this bias. To avoid this, regularly review your financial choices and be open to changes that could improve your situation. The illusion of control is the tendency to overestimate one's ability to control events, especially in the financial markets. Believing you can predict or influence the stock market outcomes more than you actually can. This can lead to overtrading and taking unnecessary risks. We can see this bias manifesting during frequent stock trading based on gut feelings rather than solid research. Accepting this unpredictability and focusing on well-researched strategies rather than trying to control outcomes can help mitigate this bias. Miscalibration is the tendency to overestimate the accuracy of our knowledge and predictions, which doesn't match reality. People often think they know more about the market than they actually do, leading to overconfidence. This bias can result in poor decision-making and investment losses. An example is when an investor confidently predicts a stock's future price and invest heavily, only to be proven wrong. To improve accuracy, regularly compare your predictions to actual outcomes and adjust your confidence levels accordingly. The default effect occurs when we stick with preset options because it's easier than exploring alternatives. People are likely to stick with default choices in financial decisions, like retirement savings plans. Defaults can significantly impact financial outcomes, as many people stick with initial settings. A classic example is automatically enrolling in a retirement plan with conservative investment options and not changing it throughout your lifetime. Take an active role in your financial decisions by exploring and choosing the best options available, rather than sticking with defaults. Hyperbolic discounting is the tendency to prefer smaller, immediate rewards over larger, later rewards. Choosing to spend money now rather than save for the future, because immediate gratification is more appealing. This can hinder long-term financial planning and savings. Opting to buy a new gadget instead of contributing to a retirement fund is an all-familiar example of hyperbolic discounting. To resist immediate temptations, set up automatic savings and investment plans that prioritize your long-term financial goals. Hedonics is about how we perceive pleasure and pain, often leading us to prioritize short-term enjoyment over long-term benefits, influencing financial decisions. It is making spending decisions based on immediate emotional responses rather than rational analysis. Understanding hedonics can help in creating better saving and spending habits. Some of us do this by splurging on luxury items to feel good, even if it strains your budget. Balance short-term pleasures with long-term benefits by setting a budget that allows for both enjoyment and savings. We often switch between calculative thinking, analytical, and intuitive thinking, gut feelings, in financial decisions. Balancing between data-driven and instinctual decision-making can impact financial outcomes. Understanding when to rely on each approach can improve decision-making. Using data to choose investments, but also considering personal intuition about market trends is a classic example of this bias. To overcome this bias, use analytical decision-making for significant financial choices and limit impulse buys by waiting before making purchases. The theory of regret involves anticipating the regret we might feel from making the wrong decision, which can influence current decisions. It involves avoiding decisions that might lead to regret, even if they could be beneficial. Fear of regret can lead to overly cautious or hasty financial choices. This bias is too often displayed when we pass on investing in a promising stock to avoid potential regret if it fails. Mitigate regret by making well-informed decisions and accepting that some degree of uncertainty is always present in investing. Finally, the endowment effect is the tendency to value what we own more highly than what we don't. People often overvalue their possessions simply because they own them. This can lead to holding on to investments or possessions longer than is financially wise. Refusing to sell a stock that has sentimental value, even if it's underperforming, is a classic display of endowment effect. Objectively assess the value of your assets by comparing them to market data rather than personal attachment. So, there you have it. By understanding these common biases, from anchoring and loss aversion to the endowment effect and beyond, you can start to recognize when your brain might be leading you astray. So next time you're about to make a big financial move, pause and ask yourself, is a cognitive bias at play here? You might find yourself making smarter choices and getting closer to your financial goals. Did any of these biases sound familiar to you? Let us know in the comments which one you struggle with the most. And don't forget to like this video, share it with your friends, and subscribe to our channel for more tips on how to master your money. Thanks for watching, and we'll see you in the next video. Until next time, keep an eye out for a brand new way to save and invest.